Have you ever been on a long highway journey, seen a massive truck thundering by, or maybe noticed the quiet hum of a generator powering a hospital or a critical data center?
Yeah, those huge machines we kind of take for granted.
Exactly. And have you ever stopped to truly consider the invisible giants making our modern world run? I mean, these aren't just pieces of machinery. They're like the silent arteries of our existence.
Moving goods, keeping the lights on, supporting our whole digital life.
Right. Ensuring essential services never falter. Well, today we're taking a deep dive into one of those unsung giants, Cummins Inc., stock ticker CMI.
Cummins. Yeah, a company maybe not everyone thinks about daily, but their impact is huge.
Absolutely. Their legacy stretches back over a century, all the way to 1919, and their engines and power solutions are integral to keeping everything moving, from heavy-duty trucks to, well, those vital data centers we mentioned, globally.
It's a fascinating company.
It really is. And you've asked us to unpack the complexities here,
Yeah.
especially as Cummins is going through a truly massive technological transition.
A huge shift.
So our mission in this deep dive is pretty clear. We want to extract the most important insights for you. We'll clarify their multifaceted business, understand that strategic pivot towards cleaner energy, and ultimately assess his position in this rapidly changing world.
How are they managing that balancing act? That's the core question, isn't it?
Precisely. How Cummins is balancing its legacy, the cash-generating businesses, with these substantial forward-looking investments in zero-emission solutions. By the end, you'll have a comprehensive understanding of where they are now and where they're headed, and hopefully, without getting buried in the details.
We'll try to keep it clear.
Okay, let's unpack this then. Cummins isn't just about big diesel engines anymore, is it?
No, definitely not.
It's a company really at a crossroads, navigating this huge shift in how the world powers itself, and that's where it gets really interesting.
Indeed. What's fascinating here, I think, is how a company with such a deep, century-long legacy is proactively charting a course for a decarbonized future. They're not just, reacting.
They're trying to lead it, in a way.
Yeah. Exactly. Rather than simply reacting. And this poses a fundamental challenge, a really profound question. How effectively can a company manage such an internal dichotomy? Balancing that profitable past with a very capital-intensive and, let's face it, uncertain future.
It's a struggle a lot of big industrial companies must be facing now.
It is. It's a critical test for many incumbents today.
So let's set the scene. Imagine a company that's been around for, wow, over 100 years, since 1919.
A long history.
Building the literal engines of industry. Cummins started as a diesel engine specialist, right? Mastering internal combustion.
That was their core, yeah.
But over the decades, it's evolved. It became this diversified industrial powerhouse. And now it's really at the forefront of this massive technological transition, the global shift towards cleaner energy.
Right. And their mission statement, making people's lives better by powering a more prosperous world. It sounds like standard corporate speak sometimes.
Sure, they all have them.
But here, it actually feels central to their public messaging and, I think, more importantly, to their strategic framework, especially as they navigate decarbonization.
It guides the pivot.
It seems to. And if we connect this to the bigger picture, Cummins' journey is really a microcosm of the broader industrial transition happening everywhere. Their business model, it's quite multifaceted.
Multiple layers.
Yeah, they leverage this vast global footprint and a set of business segments that are really complementary.
So they work together. They're not just separate units.
Exactly. They're not siloed. They share technology, customer relationships, and crucially, that powerful distribution network. This creates significant synergies, and historically, it's helped Cummins weather the ups and downs, the cyclicality in its core markets.
Which can be pretty severe in things like trucking.
Oh, absolutely. So the crucial insight for you to grasp here, the learner, is that the company is currently executing this really complex strategic pivot. They're balancing, on one hand, optimizing and generating cash from their legacy businesses, the internal combustion engine, or ICE businesses.
The diesels, the natural gas engines.
Right. Balancing that with, on the other hand, substantial investment in zero-emission solutions. And this dynamic tension, this pull between the past and the future, it defines their present operational and financial reality.
Managing those two paths at once.
That ability to manage these parallel paths, optimizing the existing profitable assets while aggressively investing in, frankly, unproven future technologies, that's the critical challenge for so many incumbents across various industries today.
Okay, so how does this grand old company actually operate with, like you said, one eye on the past and another on the future. They organize things into 5 distinct segments, but they're complementary.
Right, 5 pillars supporting the whole structure.
Think of it like a diverse fleet. You got your proven workhorses, maybe some high-speed racers, and then one that's still kind of in the test lab, being built for tomorrow.
That's a good analogy. And those mature businesses, the workhorses, they essentially provide the capital, the funding for investing in the emerging technologies.
Okay, let's break them down then. What are the 5?
All right, first you've got the engine segment. This is the foundation, the original core, manufacturing diesel and natural gas engines. Sizes ranging from about 2.8 up to 15 liters.
Okay, so powering what kinds of things?
Everything from heavy-duty trucks, medium-duty trucks, buses, that's the on-highway stuff, but also a huge range of off-highway equipment, construction, agriculture, you name it.
And there's an aftermarket part too.
Yes, significant aftermarket, new parts, remanufactured engines, serviced by their distribution network. This segment, last fiscal year, brought in about $11.7 billion, roughly a third of total revenue.
Okay, big slice. What's next?
Next is the components segment. This pillar supplies critical powertrain products. Things like after-treatment systems, think emissions control, turbochargers, fuel systems, automated transmissions now, electronics, filtration.
So all the crucial bits around the engine.
Exactly. And a key development here, really important, was that landmark 2022 acquisition of Meritor Inc.
Ah, Meritor. That was a big deal.
Huge. It dramatically expanded their offerings and components to include axles, drivelines, brakes, effectively making Cummins a much more integrated powertrain supplier. Not just engines, but more of the whole system.
Got it. And revenue-wise?
Interestingly, components was actually their largest segment by sales last year, just slightly ahead of engines at nearly $11.7 billion, also about a third of the total.
Okay, so engines and components are the 2 biggest pieces. What's number 3?
Number 3 is the distribution segment. This is their direct link to customers worldwide. Sales, service, support, operating through this massive global network of company-owned and independent locations.
The service network we mentioned earlier.
Precisely. And what's crucial here is its high-margin aftermarket business, all those replacement parts, the repair services. This provides a really resilient, recurring revenue stream. It's much less susceptible to economic downturns than new equipment sales.
Steady income, basically.
Very steady and profitable. This segment brought in approximately $11.4 billion, so again, around 33% of total revenue. Very significant.
Wow. Okay, so those 3 make up the vast majority. What's the 4th pillar?
The 4th is the power systems segment. This focuses on the really big engines, high horsepower stuff, typically above 15 liters. And also complete power generation systems. Think generator sets for standby or prime power.
Okay, so where would we find these?
Key markets are those places that absolutely cannot afford to lose power. Data centers are huge right now. Hospitals, critical infrastructure, commercial and industrial sites, mission-critical applications.
Makes sense. Revenue.
Last year, power systems generated about $6.4 billion, so roughly 19% of the total. Still substantial.
Okay, and that leaves the 5th one. The experimental engine in my analogy.
Exactly. The 5th segment is Accelera by Cummins, and this is where Cummins is placing its boldest bets on the future. Accelera is the primary vehicle, the brand, for their zero-emission strategy.
Okay, so what's under the Accelera umbrella?
It focuses on hydrogen production technologies, especially electrolyzers for making green hydrogen, and also a portfolio of electrified power systems, think batteries, fuel cell systems, and complete electric powertrains.
So batteries, fuel cells, hydrogen, the whole clean energy spectrum.
Pretty much. Now, as a nascent business, its revenue last year was comparatively small, around $400 million, just over 1% of the total, emphasizing it's still very much in the investment and growth phase.
Right, just getting started, relatively speaking.
Absolutely. And this segmented view, it really helps you understand where the company's financial strength comes from today and where its future growth bets are being placed. It vividly illustrates that company in transition idea.
You can see the split clearly.
Yeah. I mean, if you look at recent quarterly results, say Q2 2025, for example, the engine and component segments, they both contracted significantly, down 8-9% or so, reflecting that cyclical downturn in the truck market we talked about.
Hit hard by the cycle.
Right. But in stark contrast, the power systems segment grew by a robust 19% and hit a record 22.8% EBITDA margin. Why? Primarily driven by that insatiable demand from data centers.
Wow, huge difference. And Accelera.
Accelera posted a substantial EBITDA loss, around $100 million loss in that quarter, reflecting the heavy investment required to scale up, build factories, R&D, building a business for the future.
So that internal divergence, that split, that's central to their whole plan.
It is absolutely central to the strategy. It highlights the challenge, right? Managing cash flow from these mature, sometimes cyclical businesses to fund this high-growth, very capital-intensive, and for now, unprofitable new venture.
The profitable legacy segments are basically funding Accelera's runway.
Exactly. They are the essential fuel funding Accelera's path to viability, hoping it gets there before the long-term decline in the legacy businesses potentially becomes unmanageable. It's a critical balancing act. Hashtag 1.3. Global footprint, North American heartbeat.
Okay, so they operate globally, but where did the money actually come from,
Yeah.
geographically speaking?
Well, while Cummins is truly global, operating in about 190 countries, its financial heartbeat is very much in North America.
Really? How much?
For fiscal year 2024, the United States accounted for 57% of their total revenue, almost 60%.
Wow. So nearly 60% from just the U.S. Imagine a company with toes in every ocean, but its main anchor is firmly planted in American soil.
That's a good way to put it. It means what happens here, the U.S. economy, industrial activity, the regulatory environment, it really, really matters for their overall financial health.
What about other big markets? China? India?
China is a key growth market, came in around 9% of revenue last year. India was just over 5%. Other international markets made up the rest, about 29%.
So China and India are important, but still relatively small compared to the U.S.
They are important growth avenues, often managed through joint ventures, and they do offer some diversification. Sometimes international performance can be countercyclical to the U.S., but they also expose Cummins to, geopolitical risks and increasing competition from local manufacturers in those regions.
Right. So bottom line, while they are diversified, U.S. trends remain the dominant force.
Absolutely. Highly sensitive to U.S. trends. Okay, this brings us nicely to Destination Zero, which is the formal name, the banner, for Cummins' comprehensive strategy to achieve net zero emissions by 2050.
Destination Zero. Ambitious goal.
Very. But what's key here, as we touched on, is that it's not a singular bet on one technology. It's a very pragmatic, dual-path approach.
Dual path.
Meaning it's designed to provide flexibility and resilience no matter how fast or, frankly, how slowly decarbonization happens globally or in different sectors. It reflects a deep understanding of just how complex this energy transition is.
Okay, so what are the two paths?
Path 1 involves advancing internal combustion engine, ICE technology.
So improving the current engines.
Exactly. This strategy acknowledges a fundamental reality. Diesel and natural gas engines, they're going to remain critical power sources for many applications for decades to come. You can't just switch them off overnight.
Right, especially for heavy-duty long-haul stuff.
Precisely. So the focus here is on making these ICE engines significantly cleaner, more efficient, and importantly, enabling them to operate on a range of low-carbon fuels.
Like biofuels or renewable natural gas.
Yes, and also hydrogen. That leads to a key innovation here. They're fuel-agnostic engine platforms. For example, the Cummins Halum series.
Yeah, helm, like the helm of a ship.
Yeah, I think that's the idea. These platforms share common base engine components, the block, the core parts, but they can be adapted with specific cylinder heads and fuel systems for different fuels.
Ah, so one basic engine design, but you can tweak it for.
For natural gas or hydrogen, what they call H2 ICE, hydrogen internal combustion or advanced cleaner diesel.
Okay, that sounds pretty clever. What are the benefits?
Multiple benefits. It reduces complexity for the truck and equipment makers, their OEM partners. It creates manufacturing economies of scale for Cummins. It provides customers with a practical, lower carbon bridge to an eventual zero-emission future. And critically,
It keeps money flowing.
it continues to generate the cash flow necessary to fund the second path.
Right. Okay, so what's path 2?
Path 2 is a focused investment in zero-emission solutions. And this is primarily executed through that Accelera by Cummins brand we discussed.
The innovation hub.
Exactly. Accelera is concentrating on 3 core areas: battery electric systems, fuel cell electric systems, and the production of green hydrogen via electrolyzers.
A whole zero-emission toolkit.
Pretty much. This segment represents the significant long-term growth opportunity, and it's receiving substantial R&D and capital investment. Management has set a really critical target for Accelera.
The break-even target.
Yes, to achieve break-even profitability by 2027. That's a key milestone everyone is watching. It will signal the viability or lack thereof of this long-term strategy.
Wow. Okay, so Destination Zero. It really is like playing two tracks at once, making current engines better and greener while building the totally new stuff simultaneously.
It is. It's like upgrading your horse-drawn carriage for cleaner fuels and building a spaceship, as you said earlier.
And they're using their existing strengths to pull this off, right? Like that massive distribution network.
Oh, absolutely crucial. That distribution segment, with its global network of over 7,800 service locations, that's a huge competitive advantage, a real moat.
Hard for newcomers to copy.
Very hard. New pure-play zero-emission competitors simply can't replicate that easily or quickly. And this network ensures that as Cummins introduces new technologies like H2IC engines...
Customers aren't scared off by service worries.
Exactly. There's already a trusted service infrastructure in place. It reduces adoption risk for customers, and it provides that stable, high-margin aftermarket revenue stream we keep mentioning.
Which helps fund everything else.
Right. The resilience of this operational foundation, particularly as they navigate uncharted technological territory, is a really crucial competitive edge. It's a powerful asset. Okay, so Cummins' performance, its finances, they are inextricably linked to the health of several very large, very cyclical, and rapidly evolving industrial markets.
Ups and downs are just part of the game for them.
Absolutely. And the current environment presents this fascinating, really stark contrast. On one side, you have a power generation market that's booming, driven by long-term trends.
Secular growth, they call it.
Right. And on the other side, you have the on-highway truck market and the off-highway equipment markets, which are currently cyclically weak.
It's like riding a roller coaster and a rocket ship at the same time.
That's not a bad way to put it.
Yeah.
This segment-by-segment analysis is crucial for understanding where the company's current strength and weakness lies.
Okay, let's break that down. The truck market first. That's their biggest, right?
Yes. The heavy-duty and medium-duty truck market is their most significant end market. And right now, it's experiencing a sharp cyclical downturn.
How sharp?
Well, in the second quarter of 2025, industry production for Class 8 heavy-duty trucks in North America, the big rigs, fell by a dramatic 27% compared to the previous year.
Wow, over a quarter drop.
And medium-duty truck production declined even more significantly, around 36%. Industry forecasting firms like ACT Research, they anticipate this trend of lower production will continue into 2026.
What's causing the slump?
Several factors. Freight volumes have moderated from the post-pandemic highs. High interest rates are making it more expensive for fleets to buy new trucks. And as we'll discuss more, there's significant uncertainty around upcoming emissions regulations.
Ah, so customers are hitting pause, waiting to see what happens.
Exactly. It's causing customers to delay purchasing decisions.
Okay, what about the off-highway markets? Construction, mining.
Those are also highly cyclical, influenced by things like global GDP growth, government infrastructure spending, commodity prices. The global construction equipment market is forecast for pretty modest growth over the next few years. Mining equipment has been a bit mixed recently, regionally.
So challenges there too. But then there's the rocket ship part, power generation.
Right. In stark contrast, the power generation market is in the midst of a secular boom. Long-term sustained growth.
Driven by?
Primarily by the exponential increase in global electricity demand, particularly from data centers needed to power cloud computing and, increasingly, artificial intelligence.
Our hunger for data and AI is fueling Cummins generators.
Directly. The International Energy Agency, the IEA, projects global electricity demand will grow significantly, around 3.4% annually through 2026. And they estimate that electricity consumption just from data centers, AI, and crypto could actually double in that same period.
Double. That's incredible.
It provides a powerful, sustained tailwind for Cummins' Power Systems segment, which, remember, specializes in the large generator sets these facilities require. The overall global market for power generation equipment is projected to grow robustly, maybe 8% compound annual growth rate through 2032.
So that really tells you where the company finds its current strength. That diversified portfolio is paying off.
Absolutely. It demonstrates how diversification can offer resilience. And it highlights the importance of distinguishing between those temporary cyclical pressures and these long-term secular trends when you're evaluating an industrial company like this.
Okay, let's dig into those regulations you mentioned, because this seems like a real double-edged sword for the industry.
It absolutely is. The regulatory landscape is one of the most significant forces shaping the commercial vehicle industry. It acts as both a powerful driver of technological innovation,
Forcing companies to build cleaner engines.
right, but also as a major source of market uncertainty and volatility.
Talk about the big one coming up, the EPA's Clean Trucks plan.
Yes, the U.S. Environmental Protection Agency finalized this plan, which includes incredibly stringent new emissions standards for heavy-duty engines. They're set to take effect for model year 2027 vehicles.
How stringent are we talking?
We're talking a substantial technological hurdle for the entire industry. For example, the standard for nitrogen oxides, or NOx, a key pollutant contributing to smog, will be reduced by over 80% from current levels.
80%, that's huge.
It requires major advancements in engine design and, critically, in after-treatment technology, the systems that clean up the exhaust.
Like catalytic converters, but more advanced.
Much more advanced. For instance, many experts believe compliance will require new after-treatment systems with things like electric heating elements, powered by a separate 48-volt electrical system on the truck.
Just to keep the catalyst hot enough.
Exactly. To keep the catalysts at their optimal operating temperature, especially during low-load conditions like idling, where exhaust is cooler, it adds complexity and cost.
So how's Cummins responding?
They're making massive investments, over $1 billion across their U.S. manufacturing facilities, New York, North Carolina, Indiana, to upgrade the plants.
$1 billion just for this.
Primarily to produce the new engine platforms, like that fuel-agnostic Halem X15, which are specifically designed to meet these stringent 2027 standards.
But you mentioned uncertainty.
Yes, and here's the friction. While the rules are finalized, they are currently facing significant legal and political challenges. There are lawsuits pending.
So it's not a done deal that'll stick.
There's uncertainty. And this regulatory ambiguity has a chilling effect on the market. Normally, before strict new rules take effect, you see a pre-buy cycle. Fleets rush to buy trucks with the current, less expensive technology.
But that's not happening now.
Not really. It's stalled. Because many customers are delaying purchasing decisions, waiting for clarity on whether these rules will actually be implemented as planned, or if they might be delayed or modified. And this hesitation is a primary contributor to the current softness in the North American truck market.
It's a real catch-22 for everyone. Invest billions for rules that might change, or wait and risk being caught unprepared.
Exactly. It's a huge capital allocation puzzle for manufacturers and a big source of friction in the market right now. Okay, let's talk competition. Cummins operates in a highly competitive environment. They face pressure from two main sources: large, vertically integrated OEMs.
The big truck makers who build their own engines.
Precisely. Companies like Daimler Truck with their Detroit diesel engines, Volvo Group, which owns Volvo Trucks and Mack Trucks, and PACCAR, the parent of Kenworth and Peterbilt, with their PACCAR MX engine. These are major global players.
And the second source of pressure?
Other independent industrial giants. In the off-highway and power generation markets, Caterpillar is a huge, formidable global competitor.
So, big rivals everywhere? What about that vertical integration trend?
That's a major strategic trend, particularly in the commercial vehicle industry. These large OEMs are increasingly focused on designing and marketing fully integrated powertrains.
Meaning the engine, transmission, axles, all designed to work together perfectly.
Exactly. Engineered as a system, the motivation is clear, they can optimize fuel efficiency and performance better, and crucially, they capture a greater share of the total vehicle's value chain for themselves.
Which is a direct threat to Cummins' traditional role.
It's a direct competitive threat to Cummins' role as the leading independent supplier of engines and major powertrain components.
So it's a fierce game out there. But you also see collaboration, this co-opetition.
Yes, and what's fascinating here is how this competitive landscape shifts. It moves from pure rivalry towards strategic collaboration, especially when the industry faces these truly disruptive technological transitions like decarbonization. The costs and technical challenges are just immense.
Too big for any one company alone.
Often, yes. You see examples like Daimler Truck and Volvo Group forming joint ventures for fuel cell development that's cell-centric, and for electric vehicle charging infrastructure that's Milence. They're competing fiercely in selling trucks, but cooperating on developing the underlying tech.
Interesting. And Cummins is involved in this too, that Daimler partnership.
Yes, and the Daimler Truck partnership with Cummins for medium-duty engines is particularly significant. It's a real strategic coup for Cummins.
What's the deal exactly?
Under this agreement, Daimler Truck will actually stop its own investment in developing its next generation of medium-duty engines needed to meet future Euro 6 emissions standards.
They're giving up on their own engines.
For that specific medium-duty segment, yes. Instead, they will source these next-generation engines from Cummins, and Cummins will even establish production capacity within a Daimler facility in Germany to supply them.
Wow. That's huge validation for Cummins Tech.
It's powerful validation of Cummins' technological leadership in advanced ICE technology. It effectively neutralizes a major competitor in this key segment and converts them into a large, long-term customer.
Securing future revenue.
Significant future revenue, yes. And it allows Cummins to leverage its own massive R&D investments across a broader customer base. It's a strategic win. It turns a competitor into a key client. That's a mic drop moment.
It really is. And it raises that question again. Will we see more deals like this as decarbonization gets even tough and more expensive?
I think it's quite possible. It signals recognition, even by the most integrated OEMs, that specialized expertise, especially in complex areas like emissions compliance, can sometimes be more efficient to source externally. Hashtag TAG 2.4. The electrification tidal wave.
Okay, let's talk about the really big wave building in the background. Electrification.
Yes. The long-term secular shift towards electrification, whether battery electric or hydrogen fuel cell, is arguably the most profound disruptive force facing the traditional diesel engine market.
It's not just a blip, it's a fundamental change.
It is. And while it's still in its early stages in some segments, adoption is accelerating, driven by, well, tighter global emissions regulations, constantly improving technology, and importantly, the decreasing total cost of ownership for electric options in certain applications.
How's it looking in the heavy-duty truck segment, the big rigs?
Adoption there remains nascent, very early days. In 2023, zero-emission trucks, mostly battery electric, accounted for just a tiny fraction, like 0.28% of new heavy-duty registrations in the U.S.
So, still overwhelmingly diesel.
Yes. But the trend is undeniable. Every single major OEM, Daimler, Volvo, PACCAR, they're all actively developing, marketing, and now selling electric truck models. This transition is fundamentally altering the competitive landscape. It pits the established incumbents against each other and also against potential new entrants like Tesla.
What are the main hurdles holding back faster adoption in long-haul trucking?
Several significant barriers remain. The high upfront cost of the battery technology is still a major factor. The real scarcity of widespread public charging infrastructure capable of handling heavy-duty vehicles is a huge logistical challenge. And then there are persistent concerns about vehicle range and the impact of heavy batteries on payload capacity.
Can't sacrifice cargo weight for batteries in trucking.
Exactly. So for long haul, it's still tough. However, for certain applications, like regional haul, shorter, predictable routes, and port drayage moving containers around ports, electric trucks are becoming increasingly viable and cost-effective.
So it's not crashing on the shores of long haul just yet, but the signs are there. And for some uses, it's already making sense.
That's right. It's a classic example of disruptive innovation. While current adoption rates look low on the surface, the underlying trends, regulatory pressure, cost improvements, increasing viability for specific use cases, they all suggest an inevitable shift over the long term.
And the challenge for companies like Cummins
is to manage that transition period effectively, developing solutions that bridge the gap, like their H2 ICE engines or advanced diesel, while fully embracing and investing in the long-term direction of the market, which is clearly towards zero emissions. Every major player is either trying to ride that wave or build a bigger surfboard. So despite all these challenges and transitions, Cummins possesses several really durable competitive advantages. Moats, as investors like to call them. These have allowed it to maintain a leadership position in its core markets for, well, decades.
These are the things that make it hard for others to compete.
Exactly. They're classic examples of sustainable competitive advantages that are difficult for new entrants or even established rivals to replicate easily.
Okay, what's the first one? Let's build this castle.
First, I'd say technology and scale. Cummins has had this singular focus on powertrain technology for over a century. That creates a deep reservoir of engineering expertise and know-how.
They know engines inside and out.
Absolutely. And their ability to consistently meet those increasingly stringent emissions regulations year after year, cycle after cycle, that is a key differentiator. It's incredibly complex and expensive.
And that's backed by serious R&D spending.
Yes, underpinned by significant and sustained investment in R&D. We're talking well over $1 billion annually, consistently. Their scale as the leading independent engine manufacturer gives them a crucial economic advantage here.
How so?
They can amortize those massive R&D costs over a much larger and more diverse customer base compared to a vertically integrated OEM who primarily develops engines just for their own trucks.
Ah, spreads the cost wider.
Right. And the sheer technical complexity and capital intensity of meeting standards like the upcoming EPA 2027 rules, that actually serves to reinforce this moat. It raises the barrier to entry even higher for smaller competitors.
Okay, so tech and scale is wall number one. What's the second layer of defense?
The second, and arguably its most formidable advantage, is that global distribution and service network.
Of thousands of service locations worldwide.
Exactly. Unparalleled reach. Operating in roughly 190 countries through a network of over 600 company-owned and independent distributors and more than 7,400 dealer locations.
That's huge.
It's massive. And for commercial customers, vehicle uptime, keeping that truck or machine running, is absolutely paramount. It's how they make money.
Downtime costs them big time.
Right. So the ability to quickly access genuine parts and expert service literally anywhere in the world is a critical factor in their purchasing decisions. It builds incredible customer loyalty.
And it makes money for Cummins too, right? The aftermarket stuff.
Yes, crucially, this network generates a stream of high-margin, resilient aftermarket revenue parts and service. This provides a vital financial cushion, especially during cyclical downturns when new equipment sales slow down. This network isn't just a sales channel, it's an operational moat that, as we discussed, drastically lowers the adoption risk for customers considering new Cummins technologies like hydrogen engines. It's a really crucial, often underestimated asset in this energy transition.
Okay, solid second wall. What's the third?
The third wall is their brand reputation and OEM relationships. The Cummins brand is globally recognized. It's synonymous with power, reliability, durability.
Things you definitely want in a heavy-duty engine.
Absolutely. This strong brand equity has been cultivated through decades of proven performance in the most demanding applications. Furthermore, Cummins has established deep, long-standing relationships with a broad portfolio of original equipment manufacturers, OEMs across the truck, bus, construction, industrial markets, you name it.
So the companies that actually build the vehicles and equipment trust Cummins.
They do. Cummins is an essential partner, especially for those OEMs that don't have the scale or the desire to produce their own engines in-house. Think about PACCAR, owner of Kenworth and Peterbilt, or Navistar. They rely heavily on Cummins.
And that recent Daimler partnership we talked about.
That further cements Cummins' status as a technology partner of choice, even for the largest, most vertically integrated OEMs. It demonstrates that even rivals recognize their expertise.
So you've got incredible engineering smarts and scale, an unmatched global service network, and a rock-solid brand with deep industry relationships. That is a tough castle to breach.
It provides significant resilience and competitive insulation.
Okay, so with those advantages, how does Cummins actually stack up in terms of market share? Where do they lead?
It's important to note that precise, up-to-the-minute market share data is often proprietary and fluctuates quite a bit. But available information and company disclosures give us a pretty clear picture of their strong position, especially in North America.
Right, their main market. Let's start with the big trucks, Class 8.
In the North American heavy-duty Class 8 truck market, Cummins has long been a leader. Data from a couple of years ago, like the first half of 2022, showed Cummins as the leading overall supplier of Class 8 diesel engines, providing something like 35.5% of the total units used.
Over a third of all big truck engines.
Yes. And their dominance is particularly strong in the vocational segment. Think construction trucks, garbage trucks, that kind of thing, especially for engines under 10 liters.
Yeah.
There they had something like an 86% share. Just dominant.
Wow. What about the long-haul segment, the highway tractors?
That segment, typically using larger engines over 10 liters, is more competitive. In that same period, Daimler's own Detroit diesel engine held a slight lead over Cummins. But Cummins is still a major player, especially as the engine supplier for PACCAR's Kenworth and Peterbilt brands.
Got it. What about medium-duty trucks, the smaller delivery trucks, box trucks?
The North American medium-duty truck market is generally more fragmented than the heavy-duty market. There isn't one single dominant engine supplier.
More players involved.
Right. A report from 2024 indicated that Cummins, primarily with its widely used B-Series and L-Series engines, along with PACCAR's own engines and Volvo Group, collectively held a significant share, maybe over 16% together. Cummins is definitely a significant player.
And that Daimler partnership we keep mentioning, that's going to boost their share here.
Right. Yes, that strategic partnership with Daimler to supply next-generation medium-duty engines is expected to significantly bolster Cummins' market share in this important segment later this decade. That's a future catalyst for share gains.
Okay. But you mentioned the market is dynamic.
Very dynamic. And it's important to reiterate that specific 2023-2024 share data isn't readily available, and the market has been slowing down as management anticipated. So recent share figures have likely been impacted by that overall market softness.
So strong historical position, especially in heavy duty, and potential upside in medium duty, thanks to that Daimler deal. But the current market is tough.
That's a good summary. And underlying all this market position, all these competitive advantages, is that foundation of substantial and sustained investment in technology.
The R&D spending we touched on. This company isn't just coasting, it's pouring serious money into this.
Serious money. Over $1.5 billion in 2023 and around $1.46 billion in 2024.
Annually. That's huge.
Yeah. It is. It represented about 4.4% of their sales in 2023. This sustained level of R&D investment is absolutely critical for their long-term viability, especially being in such a capital-intensive industry that's facing a massive technological paradigm shift.
Where is that money going? Is it just making diesel better, or?
It's really focused on that Destination Zero dual path strategy. So a large portion is absolutely dedicated to advancing their core ICE platforms, making them cleaner, more efficient, meeting those tough EPA 2027 standards.
Cool.
That includes developing those HELM fuel agnostic platforms we talked about.
Investing in the present and near future.
Exactly. But concurrently, a significant and I would say a growing portion of that R&D spending is being allocated to the Accelera segment to advance the zero-emission technologies.
The hydrogen, the batteries, the fuel cells.
Right. Developing more efficient and cost-effective electrolyzers for green hydrogen production, working on next-generation fuel cells with better performance and durability, developing advanced battery systems and integrated electric powertrains.
So it really demonstrates a commitment to both sides, incremental improvements and fundamental innovation.
I think it does. They're committed to improving the legacy products while simultaneously inventing the engines of tomorrow, whether they run on hydrogen or electricity. It's a massive undertaking.
Which brings up that question again. How do they manage the ROI on these dual-track investments? That must be incredibly complex.
It's one of the core management challenges they face, absolutely. Balancing the near-term needs and returns with these very long-term, uncertain bets.
Okay, this is where Cummins really seems to be playing the long game, thinking strategically about the future. They're not just picking one horse in the clean energy race.
No, that multi-pathway approach is key. They are strategically positioning themselves across multiple decarbonization technologies, deliberately avoiding a single, potentially risky bet. Let's look at the hydrogen ecosystem.
Right, they seem very focused on hydrogen.
Very. And their strategy is comprehensive. It aims to encompass the entire value chain. This is a key differentiator.
Not just engines, but the whole system.
Exactly. Starting with production. Their Accelera business is already a leading developer and manufacturer of electrolyzers, the machines that produce green hydrogen from renewable electricity.
So they can help create the fuel itself.
Yes. Then storage and management. They have a joint venture with a company called NPROXX, which specializes in high-pressure hydrogen storage tanks, essential for handling the fuel.
Okay, production, storage, then using it.
And then application, using the hydrogen. And here they have two distinct paths, remember.
The H2ICE and fuel cells.
Right. The hydrogen internal combustion engine, H2ICE, offers a zero-carbon solution that leverages Cummins' core engine expertise. It's a more familiar technology for customers to adopt, less disruptive. It can use existing manufacturing and service infrastructure.
A smoother transition, maybe.
Potentially, yes. And then you have hydrogen fuel cells, which offer higher efficiency and are particularly well-suited for heavy-duty applications with high energy demands.
So this integrated production-to-application approach is their edge.
It's a significant differentiator. And the H2ICE, in particular, offers a very pragmatic bridge technology. It could help them capture significant market share during this multi-decade transition period, while the fuel cell technology and infrastructure continue to mature.
That makes sense. What about the battery electric side?
That's the other major thrust, primarily through Accelera as well, focusing on electric powertrains.
And the Meritor acquisition was key here.
Absolutely transformative, a game changer, as you said. Before Meritor, Cummins supplied key components like batteries and motors. But Meritor brought industry-leading e-axle technology.
The integrated motor, gearbox, and axle unit.
Exactly. So now Cummins can offer a complete, fully integrated e-powertrain solution. This is critical.
Why is that integration so important?
Because vertical integration of the powertrain components is crucial for optimizing the performance, efficiency, and range of electric vehicles. It allows Cummins to compete directly with the integrated electric drivetrain offerings from the big OEMs like Daimler and Volvo.
So it's defensive to avoid just being a parts supplier.
Yes, avoiding marginalization, but also offensive, allowing them to capture a much larger share of the value in the growing electric vehicle market.
From supplying ingredients to delivering the whole meal.
That's a perfect analogy. And they're actively forming partnerships here too, like their work with Bluebird to ramp up production of electric school buses using Cummins electric powertrain.
So a full ecosystem approach for hydrogen and a major strategic acquisition to become a full system supplier for electric. They're making big moves.
They are. It reflects a clear understanding that in these emerging technologies, offering integrated solutions and leveraging existing strengths like that service network for H2 ICE can really accelerate adoption and create lasting competitive advantages. It positions them as a strategic partner, not just a part supplier, for the future of commercial power.
Okay, let's switch gears a bit and look at the financials. How has Cummins performed over, say, the last decade?
It's been a dynamic journey, as you might expect from a company tied to industrial cycles. Their net sales have grown substantially, from around $19.1 billion back in 2015 to $34.1 billion in fiscal year 2024. That's a compound annual growth rate of about 6.6%.
Solid growth over the long term, but bumpy.
Definitely not linear. There have been periods of cyclical contraction, like during industrial recessions, followed by strong recoveries. The significant revenue jump you see from 2021 to 2023, for instance, was heavily influenced by the strong post-pandemic demand recovery and the addition of billions in annual sales from that Meritor acquisition.
Right, M&A playing a big role.
Yes. And we should also keep in mind that the recent divestiture of the Atmos filtration business, completed in March 2024, will impact future year-over-year comparisons. Revenue will likely step down initially because of that spin-off.
Okay, what about profitability? Has that held up through the cycles?
Profitability, measured by operating margins or EBITDA margins, has also fluctuated with the cycles, but it's shown, I'd say, an underlying resilience. For 2025, for example, even with the expected weakness in the North American truck market, the company is guided for quite solid EBITDA margins in the range of 16.2% to 17.2%.
That seems pretty healthy for an industrial company in a downturn.
It is. It suggests a structurally higher level of profitability compared to previous cycles. This improvement can be attributed to a few things: better pricing discipline, ongoing cost control efforts, a richer product mix thanks to the booming high-margin power systems segment, and realizing synergies from the Meritor acquisition.
And they generate good returns on capital.
Yes, that's a key strength. Their return on invested capital, or ROIC, was a robust 24% for fiscal year 2024. That's a strong indicator of efficient capital use.
Now, you mentioned things can look distorted sometimes, those one-time events.
Ah, yes. This is crucial for anyone looking at their recent reported numbers. You absolutely have to be aware of the impact of significant one-time events.
Like that big regulatory charge.
Exactly. In 2023, the reported net income, operating income, and earnings per share, EPS, were significantly impacted by that massive $2.04 billion pre-tax regulatory charge related to the emissions settlement.
How much did that skew things?
It artificially lowered their reported EPS for 2023 down to just $5.15 per share. If you normalize for that charge, which was about $13.78 per share impact, their adjusted EPS would have been closer to $18.93.
Wow, a huge difference. Nearly 4 times higher.
Right, so if you just looked at the reported $5.15 EPS, any valuation metric based on that, like the PE ratio, would look incredibly high and completely distorted.
And there was a gain in 2024, too.
Yes, conversely, in 2024, their reported net income, EPS, and even operating cash flow were positively impacted by a $1.3 billion pre-tax gain recognized on the final separation of the Atmos business.
So big swings from one-offs makes the trend hard to see sometimes.
It does. This historical view highlights that inherent cyclicality, but it also shows Cummins' ability to navigate downturns and improve its underlying profitability. The key takeaway for you, the learner, is always look beyond the headline figures. Dig into the footnotes, understand the one-time charges or gains. Normalized earnings provide a much clearer picture of the company's core financial health and operational performance. Now, despite those earnings fluctuations, Cummins has a demonstrated history of robust cash flow generation through various economic cycles. This is a real strength.
They're good at bringing in the cash, even when times are tough.
Exceptionally good sometimes. In fiscal year 2023, remember when their reported net income was hammered by that regulatory charge?
Yeah, the $5.15 EPS year.
Well, in that same year, they generated a record $4.0 billion in operating cash flow, up dramatically from $2.0 billion the year before.
How did they manage that with such a low reported income?
It wasn't driven by higher net income at all. It was almost entirely the result of incredibly disciplined working capital management. They generated a $2.4 billion inflow from working capital changes in 2023, compared to a $1.0 billion outflow the year before. They managed their inventories, receivables, payables extremely effectively.
So they basically unlocked cash tied up in the balance sheet.
Precisely. And that highlights a core operational strength, the ability to generate cash internally even when headline profitability is challenged.
And that cash flow is absolutely vital right now.
It is critical. It's the lifeblood that funds their capital-intensive transition strategy, the R&D, the CapEx for Accelera, and new engines. It also funds shareholder returns, like the dividend, and allows them to pay down debt.
Speaking of debt, how's the balance sheet looking after buying Meritor?
It's solid. As of the second quarter of 2025, they held just over $3 billion in cash and marketable securities. Total debt at the end of fiscal 2023 stood around $6.7 billion.
Which was up because of Meritor.
Yes, debt levels increased significantly in 2022 to finance that $3.7 billion acquisition. Since then, management has clearly stated that prioritizing debt reduction is a key component of their capital allocation strategy.
So managing the debt down while still investing heavily.
Exactly. The ability to generate that strong operating cash flow, even when reported earnings are messy, is the hallmark of a fundamentally strong business. That discipline in working capital is crucial for funding Destination Zero. And that strong cash position provides the necessary financial flexibility to invest aggressively while managing debt and keeping shareholders reasonably happy. That's the bedrock they need.
Okay, let's drill down into how those different segments are actually performing right now, because this is where you really see that two-speed company idea in action, right?
Absolutely. The data from the recent second quarter of 2025 provides a vivid illustration of these diverging trends. It makes that strategic pivot incredibly clear.
So who's the star performer?
Without a doubt, Power Systems, it was the standout performer. Record EBITDA margin of 22.8%.
Wow, almost 23% margin.
On strong revenue growth of 19%, driven, as we said, by that secular demand from the data center market. It's providing a powerful offset to the weakness elsewhere. It's essentially roaring ahead.
Okay, the data center boom is real for them. What about distribution? The service network?
Distribution continues to demonstrate its resilience. Revenue grew a solid 7%, and importantly, its EBITDA margins expanded significantly, up to 14.6% from 11.1% the year before.
What drove that?
Demand for power generation products sold through the network, plus the stable, high-margin aftermarket parts and service business. Steady Eddie, but very profitable.
Okay, now for the other side of the coin, the engine segment.
The engine segment, being the most exposed to that cyclical on-highway truck market, felt the pressure. Revenue declined 8%. EBITDA margin compressed slightly, down to 13.8% from 14.1%. Still decent margins, but clearly impacted by the sharp downturn in North American truck production.
Feeling the pinch. And components. The segment boosted by Meritor.
Components also saw a sales decline, down 9%, again reflecting the truck market downturn. However, they actually managed to expand their EBITDA margin up to 14.7% from 13.6% a year ago.
Interesting. How did they manage that with falling sales?
It suggests pretty effective cost control measures and likely realizing some of the benefits and synergies from integrating the Meritor business, which has some high-margin product lines.
Okay, so managing costs well there. And finally, Accelera, the future bet.
Accelera is squarely in its investment phase. On sales of about $105 million in the quarter, it recorded an EBITDA loss of $100 million.
Ouch. Burning cash.
Yes, but that's entirely expected at this stage. The company is investing heavily in R&D, building manufacturing capacity. It's all about funding future growth. It's the investment in tomorrow.
So the overall picture is crystal clear. Power systems and distribution are the primary profit and cash flow engines right now. They're providing the stability and the funds to manage the cyclical downturns in engine and components, and, crucially, to bankroll Accelera's path forward.
Precisely. This segment-level analysis underscores the critical importance of that high-growth, high-margin power systems business. It's offsetting weakness elsewhere and providing the capital needed for Accelera. It's a complex balancing act. But the Q2 2025 data shows the existing core is robust enough to support that transition, at least for now. #Tag5. Recent shocks and strategic chess moves, 2022-2024. Hashtag tag 5 tag 5.1. Battling macroeconomic headwinds.
Oh, yeah, besides the market cycles, Cummins has also had to navigate some major external shocks recently, like trying to run a global company during a perfect storm.
Absolutely. The period from 2022 onwards has been marked by significant macroeconomic headwinds. First, supply chain disruptions. These were persistent and significant, especially impacting semiconductors and other electronic components.
The chip shortage hit everyone hard.
It did. It limited production capabilities across the industry. While things have improved somewhat from the peak crisis in 2022, the global electronic supply chain remains a challenge, adding complexity and cost.
Inflation.
Yes, significant inflationary pressures. Elevated costs for manufacturing inputs, logistics, raw materials. Cummins had to respond proactively with pricing actions and material cost surcharges to try and mitigate the impact on their margins.
A constant battle to keep up with rising costs.
It has been, and then you layer on geopolitical tensions.
Like the situation with Russia.
Right. Cummins indefinitely suspended its operations in Russia in early 2022 following the invasion of Ukraine. That resulted in a pre-tax charge of about $158 million, a direct financial hit.
And China. That's a big market for them.
Yes, and a more persistent headwind has been the economic slowdown in China, exacerbated by their prolonged COVID-19 lockdowns and ongoing weakness in the property market. This led to significantly lower demand for trucks and construction equipment in what is usually a key growth region.
So navigating supply chaos, rising costs, pulling out of Russia, dealing with China's slowdown. Quite a juggling act.
It really highlights the complexities of managing a large global industrial company in the current environment. But amidst these headwinds, this period was also defined by two major, really complementary strategic portfolio actions, moves that have profoundly reshaped Cummins' focus and its financial structure.
The big acquisition and the big divestiture.
Yeah, exactly. This combination highlights some astute portfolio management, I think. First, the Meritor acquisition. Completed in August 2022. This was a landmark transaction. Cummins acquired Meritor Inc. for approximately $3.7 billion.
A huge deal for them. Why Meritor specifically?
It was a pivotal strategic move, designed to significantly bolster the component segment by adding Meritor's industry-leading portfolio of axles, brakes, and most critically, those electric powertrain or e-powertrain solutions we discussed.
The e-axles.
Right. The primary rationale was to position Cummins as one of the few suppliers capable of offering fully integrated powertrain solutions covering both traditional combustion engines and emerging electric applications. It was about accelerating that Destination Zero strategy.
And they expect cost savings, too. Synergies.
Yes, Cummins expects to realize about $130 million in annual pre-tax run rate synergies by the third year after closing the deal.
Okay, so buy big with Meritor. Then what was the other move?
Complementing that was the Atmus divestiture. This was completed in March 2024. Cummins executed the full separation of its filtration business.
Which used to be part of the component segment.
Yes. It now operates as an independent public company called Atmus Filtration Technologies. Management framed this move as allowing both Cummins and the newly independent Atmus to have greater strategic focus on their respective core businesses. Streamlining.
Makes sense. What was the financial impact of spinning off Atmus?
It was also a significant financial event. The divestiture generated a substantial one-time pre-tax gain for Cummins, about $1.3 billion, which boosted their Q1 2024 results. And the way they structured the final separation as an exchange offer also reduced Cummins' total shares outstanding by about 5.6 million shares, or roughly 4%.
So it brought in cash and reduced the share count, like a masterclass in corporate strategy. Buy a key future piece with Meritor, then spin off a solid but non-core piece with Atmus to help pay for it and streamline focus.
Exactly. And that interplay, understanding these two moves in concert, is the crucial insight here. The Atmus spinoff wasn't just about focus, it was arguably a strategic necessity.
Why necessary?
To provide the financial flexibility needed to absorb the large Meritor acquisition and, simultaneously, fund the heavy ongoing investments in the Accelera business. Think about it. Taking on nearly $4 billion in debt for Meritor while also committing to massive R&D and CapEx for Accelera, that really stretched the balance sheet.
Right, that's a lot of capital outflow.
So the separation of Atmus effectively unlocked capital from a mature, profitable, but non-core business. This allowed management to deleverage faster, reduce the share count, and reallocate financial and strategic resources towards those higher priority areas, powertrain integration and zero emissions technology.
A bold financial ballet, managing the portfolio to fund the future. Understanding that interdependency is key.
Absolutely. It shows management's willingness to make difficult decisions, even divesting a perfectly good business, to reallocate capital towards higher priority growth areas. The Atmos divestiture was essentially a funding mechanism for Meritor and Accelera.
Now, there was one other major financial event recently, that big regulatory settlement.
Ah, yes. Sometimes even well-regarded companies face significant penalties. In December 2023, Cummins announced it had reached an agreement in principle with the U.S. EPA, the California Air Resources Board, CARB, and other regulatory bodies.
What was it about?
It was to resolve claims related to emissions certification and compliance issues on certain engine systems used in pickup trucks over several years, specifically allegations regarding emissions defeat devices.
Okay. And the financial hit?
It resulted in the company recording a substantial pre-tax charge of $2.04 billion in the fourth quarter of 2023.
$2 billion. That's a huge number.
It is a very material, one-time financial event. And as we discussed earlier, it significantly impacted the company's reported net income and earnings per share for the full fiscal year 2023.
A costly lesson indeed. But it's a one-time event they've now put behind them.
That appears to be the case. Painful, yes, but resolved and accounted for financially. So with all these investments, acquisitions, settlements, how does Cummins approach allocating its capital? Where does the money go?
It seems like a real balancing act right now.
It truly is. Cummins employs a disciplined and historically very consistent capital allocation strategy. It's focused on balancing returns to shareholders with reinvestment in the business. And returning cash to shareholders is definitely a stated priority.
They aim for a specific target.
Their long-term strategic goal is to return approximately 50% of their operating cash flow to shareholders, primarily through dividends and share repurchases.
And they have a good track record on dividends.
A very strong track record of dividend growth. In July 2025, Cummins announced a 10% increase in its quarterly cash dividend. This marked the 16th consecutive year of dividend increases.
16 years straight. That's impressive consistency, even through all the cycles and transitions.
It is. The declared dividend per share for fiscal year 2024 was $7, up from $6.50 the prior year. This consistent growth really underscores the board's confidence in the company's long-term cash-generating capabilities. It signals they believe they can fund the future and reward investors.
It shows they're not just thinking about tomorrow's tech, but also rewarding the people who believe in them today. What about share buybacks?
They regularly use share buybacks as another tool to return capital, though the level can vary depending on market conditions and other capital needs. As we noted, the final separation of the Atmos business was structured as an exchange offer, which effectively acted as a significant share repurchase, reducing the shares outstanding by about 4%.
So dividends and buybacks are a clear priority. But then there's the other side of the equation, investing back into the business itself. And this seems like a period of massive reinvestment for them.
It absolutely is. The company is currently in a phase of heightened investment, arguably unprecedented in its history, to position itself for future growth and, crucially, to meet those new regulatory requirements.
Where are the big spending buckets? R&D?
Research and development, R&D, is a top priority, as we've discussed. Spending levels are elevated to support that dual-path strategy, advancing ICE and developing zero-emission tech. Again, that was $1.5 billion in 2023, $1.46 billion in 2024. Huge numbers.
Building things, factories, production lines.
Yes, capital expenditures, CapEx, has also increased significantly. This is for launching new product platforms like the 2027 compliant engines and expanding manufacturing capacity, both for traditional products and for Accelera. CapEx was running at about $1.21 billion in both 2023 and 2024.
And a big chunk of that is for the U.S. plants.
Yes, a significant portion of that recent CapEx is dedicated to retooling those U.S. manufacturing facilities in New York, North Carolina, and Indiana to produce the new engines required for the 2027 emissions standards.
And then there was M&A.
Right. Mergers and acquisitions, M&A. The $3.7 billion Meritor acquisition in 2022 stands out as the most significant recent use of capital for M&A, strategically deployed to accelerate their electrification strategy.
So this is the real high-wire act for Cummins. Billions on R&D, billions on CapEx, billions on M&A. That's a massive outflow of cash.
It is, and this creates the fundamental tension in their capital allocation story right now.
The conflict between shareholder returns and these huge investments.
Exactly. That long-standing policy of returning 50% of operating cash flow faces immense pressure from the non-discretionary capital requirements of this energy transition.
Non-discretionary meaning they have to spend it.
Largely, yes. Funding Accelera's operating losses, remember, $100 million EBITDA loss in just one recent quarter. Funding record-level CapEx, around $1.2 billion annually. Funding massive R&D, nearly $1.5 billion annually. These are huge demands.
And they're in direct competition for capital with dividends and buybacks.
They are. It forces a very delicate balance. Management's ability to successfully navigate this, to maintain their commitment to shareholders while fully funding the necessary transition investments, will be a key determinant of the company's financial health over the next decade.
What's the near-term focus?
Based on recent commentary, the near-term priorities for free cash flow after funding the necessary R&D and CapEx appear to be paying the dividend and reducing the debt taken on for the Meritor acquisition. Buybacks might be less of a priority until the balance sheet is stronger.
So how do you do both invest heavily and return cash without breaking the bank? It really tests the strength of the core business.
It does. This capital allocation strategy represents a profound test. The success hinges on the core business continuing to generate substantial cash flow and on disciplined working capital management. The focus on debt reduction post-Meritor is a prudent move to maintain balance sheet stability during this critical period of elevated investment.
Okay, let's look forward. What are the big growth opportunities Cummins is chasing? Hydrogen seems like a major one.
Absolutely. Cummins is positioning itself not just as a player, but as a potential leader across the entire hydrogen value chain. And that full spectrum approach is a key differentiator.
Building the whole hydrogen world, like we said, starting with making the hydrogen.
Yes, green hydrogen production. Through their Accelera brand, Cummins is already a major global player in the market for electrolyzers, the technology used to produce green hydrogen using renewable electricity and water.
Where are they making these?
They are aggressively expanding their manufacturing capacity for electrolyzers globally. They have facilities or plans in Spain, Minnesota, here in the U.S., Belgium, Canada.
So they're betting big on the infrastructure build-out.
Exactly. This positions Cummins to capitalize on the expected multi-billion-dollar global build-out of hydrogen infrastructure over the coming decades. They recently announced a major win, too.
Oh, yeah. What was that?
A contract to supply a 100-megawatt PEM electrolyzer system for a large green hydrogen project being developed by BP in Germany. That's the largest single electrolyzer project for Accelera to date. A significant validation.
Okay, so making the fuel, then using it. The H2-ICE engines.
Right. Hydrogen internal combustion engines, H2-ICE, represent a really significant near to medium-term growth opportunity for Cummins.
Why near term?
Because they offer a zero-carbon power solution that leverages Cummins' core manufacturing competencies and, crucially, utilizes their existing global service network.
Easier for customers to adopt. Less scary than fuel cells, maybe.
Potentially, yes. It's far less disruptive for OEMs and end users compared to fuel cells. It integrates more easily with existing vehicle platforms and service practices, familiar technology just running on hydrogen.
Are they testing these out yet?
Yes, they're actively validating their 15-liter hydrogen engine with major fleet partners like Werner Enterprises, one of the largest trucking companies, gathering real-world data ahead of planned commercialization.
So, the full ecosystem. Make it, store it, burn it in familiar-ish engines, or use it in fuel cells, providing all the pieces.
That's the strategy. The comprehensive approach, particularly the H2-ICE offering, is a powerful bridge technology. It addresses the practical realities of fleet adoption by minimizing disruption while still delivering on decarbonization goals. It's pragmatic.
But the big question remains.
How quickly will the hydrogen refueling infrastructure be built out to actually support these new engines at scale? That's the external dependency. The other major growth vector is, of course, electrified powertrains. Accelera is the core of Cummins' battery electric strategy here.
And Meritor was the key.
Meritor was critical. That acquisition provided Cummins with a complete integrated e-powertrain solution, including that all-important e-axle technology. This allows Cummins to compete effectively as a full system provider in the rapidly growing market for electric commercial vehicles, not just as a component seller.
Going head-to-head with the OEM's own electric drivetrains.
Exactly. And they're actively collaborating through partnerships to scale up. We mentioned the Bluebird collaboration for electric school buses. That's a prime example of putting their integrated e-powertrain into action.
So with Meritor, they went from supplying electric bits and pieces to delivering the whole electric skateboard, ready for vehicle makers to build on top of.
That's a very apt description. Full system capability.
Now, let's talk about where Cummins is making serious money right now, that power systems segment and the data center boom.
Yes, this is currently Cummins' most powerful and, importantly, most profitable growth driver. The power systems segment is benefiting directly and significantly from that secular boom in demand for data centers, fueled by AI and cloud computing.
It's like they struck gold in the digital age.
It really is a gold rush for reliable power provider.
Right.
Remember those Q2 2025 numbers? Revenue grew 19% with record profitability near 23% EBITDA margin. Just phenomenal performance.
And this isn't expected to be short-lived.
No, the consensus is that this demand will be sustained as global data consumption continues its exponential growth. This isn't just a transient boom, it's a fundamental shift in global infrastructure needs that plays directly to Cummins' strengths in reliable, high-horsepower power generation.
Are they investing to keep up?
They are. Cummins is investing over $200 million to expand its manufacturing capacity specifically for these large generator sets in key locations, the US, England, India, just to meet the surging demand.
So this segment is crucial right now.
Absolutely crucial. It provides a high-margin revenue stream that significantly de-risks their overall transition strategy. It's the engine funding much of the rest of the transformation.
Yeah.
And we shouldn't forget the bedrock beneath much of this, the aftermarket.
The parts and service business.
Exactly. There are millions upon millions of Cummins engines in operation globally, across all their markets. This massive installed base creates a large and incredibly resilient aftermarket revenue stream.
Engines need maintenance, they break down, they need parts.
Precisely. This business, managed primarily through the distribution segment, includes the sale of replacement parts and repair services through that extensive network.
And the key characteristics: less cyclical, higher margins.
Both. It's much less susceptible to economic downturns than new equipment sales, and it typically carries significantly higher profit margins. It's a crucial source of financial stability.
Like a steady, high-margin annuity.
That's a good way to think of it. It helps the company navigate industry downturns smoothly and provides essential cash flow to fund their long-term strategic investments, like Accelera. It's the financial safety net.
Okay, it sounds like Cummins has a lot going for it, but no company is without risks. What are the main things investors should be watching out for?
Definitely. Like any large industrial company, Cummins is significantly exposed to cyclical and economic risks.
The ups and downs of the economy.
Right. Particularly their significant exposure to those highly cyclical, heavy-duty truck, construction, and mining markets. These industries are very sensitive to changes in overall economic conditions, interest rates, freight volumes, commodity demand.
So a prolonged recession would really hurt.
A prolonged or deep downturn would significantly hurt revenue and profitability in their core engine and component segments. That's a constant risk factor.
What about customer risk? Relying too much on a few big ones.
That's another one, customer concentration. Cummins relies on a few very large OEM customers like PACCAR, which accounts for over 10% of their total sales, for a significant portion of its on-highway revenue.
So if PACCAR decided to build more of its own engines.
Exactly. The loss of a major customer or a strategic decision by one of these large OEMs to further vertically integrate and insource more of their own engine production poses a significant potential threat to Cummins' market share and revenue. Beyond the economic cycles, there are major risks tied to the future itself. The energy transition risk is probably the primary long-term strategic risk.
The risk that they don't transition successfully.
Precisely. A failure to develop, commercialize, and scale competitive and economically viable electric or hydrogen solutions in a timely manner could lead to a significant and potentially permanent loss of market share as the world moves away from traditional fossil fuels. This is the big one.
And the regulations themselves are a risk.
Yes, emissions regulation risk. Their products are subject to extensive, complex, and increasingly stringent standards globally. The unpredictability in the adoption, implementation, and enforcement of these standards, look at the uncertainty around EPA 2027 right now, creates significant business uncertainty and can cause demand volatility, like the stalled pre-buy.
And compliance failures can be costly.
Very costly. Compliance failures can lead to substantial financial penalties. Witness the $2.04 billion settlement, expensive recalls, and significant reputational damage.
Any other product risks.
Well, inherent in manufacturing complex machinery, like engines and power systems, is the risk of product recalls and liability claims if things go wrong. That's always a background risk.
So the energy transition regulations, product issues,
Mhm.
lots to manage there.
These are perhaps the most significant long-term risks. The energy transition isn't just a trend, it's a fundamental shift. If Accelera doesn't scale as planned, or if regulations shift unexpectedly in ways they haven't anticipated, the financial and strategic implications could be immense. It really emphasizes the high-stakes nature of their Destination Zero strategy and the precision required in execution.
They also face risks from competitors and just operating globally, right? It's a constant battle.
Absolutely. Intense competition is a given. From those large vertically integrated OEMs like Daimler and Volvo, from diversified industrials like Caterpillar, and increasingly from rising local competition in key emerging markets like China and India.
And China itself presents risks.
Yes, China exposure. With nearly 9% of 2024 revenue coming from China, the company is exposed to potential economic slowdowns there, shifts in government policy or trade relations, and the growing capabilities of local Chinese competitors.
And the supply chain headaches we all know about.
Definitely. Supply chain vulnerabilities remain a key risk. They're susceptible to disruptions like raw material or critical component shortages. Semiconductors are still a watch item, transportation delays, labor fluctuations, any of which can potentially halt production, increase costs, and impact delivery schedules.
So fighting battles against giant competitors, the whims of big markets like China, and global supply chain issues. It's a constant game of whack-a-mole.
For any global manufacturer today, it really is. And finally, there are risks related to their own execution. Can they actually pull off these complex plans? These execution risks are where strategy meets reality.
Like integrating Meritor, that was a huge acquisition.
Exactly. M&A integration is a key near-term risk. The successful integration of the large and complex Meritor acquisition is critical. Failure to achieve those projected $130 million annual synergies or difficulties in effectively combining the two companies' capabilities and cultures could impair the long-term value proposition of that deal. It's a massive integration challenge.
And funding Accelera, making that bet pay off.
Yes. Funding the transition represents a significant ongoing operational and financial challenge. Managing the cash burn of the currently loss-making Accelera segment and successfully guiding it to the targeted break-even point by 2027 is crucial. Any failure here, or significant delays in achieving profitability, could seriously strain the company's overall financial resources and potentially compromise other strategic priorities.
So these aren't just external market risks hitting them.
No, these are internal capabilities that must perform almost perfectly. Flawless operational and financial discipline is required from the core businesses to successfully execute the Meritor integration and fund Accelera through its heavy investment phase.
Okay, let's talk about valuation. How does the market view Cummins stock? Is it expensive, cheap? It sounds complicated given all the moving parts.
It is complicated. The valuation reflects this complex interplay between the mature, cyclical legacy businesses and the high-growth, but currently unprofitable new energy ventures under Accelera. It makes simple valuation metrics tricky.
So what does something like the P/E ratio tell us?
Well, as of early September 2025, the stock's trailing 12-month price-to-earnings, or PE, ratio stood around 18.5x.
How does that compare historically?
It's moderately above its 10-year historical average, which is closer to 16.75x, so suggesting maybe a slight premium relative to its own history right now.
But you said PE can be volatile for them.
Extremely volatile, which is typical for a cyclical industrial company. For instance, that reported TTM-PC peaked at over 46x in December 2023.
Because earnings were artificially low from the settlement charge.
Exactly. That huge regulatory charge sharply depressed the reported EPS, making the PE look astronomically high. Conversely, during periods of economic pessimism, like March 2020, the PE has troughed below 10x, so you see huge swings.
Yeah.
Other metrics, like price to sales or price to book, have generally been more stable around their historical averages.
So that warning about one-time items is critical here for valuation.
Absolutely crucial. Relying solely on the headline PE ratio for Cummins right now can be highly misleading. You have to adjust for those non-recurring items.
Let's do that adjustment for 2023 again. Reported reported EPS was $5.15.
Right, artificially lowered by that $2.04 billion charge, which had about a $13.78 per share impact. So if you add that back, the normalized EPS for 2023 would have been around $18.93.
Okay, so if you calculate a PE based on that normalized number,
Then the normalized PE for 2023, using the price at the time, would have been closer to maybe 12.7x, substantially below the historical average PE.
suggesting the underlying business might have actually been trading at a discount then, despite the scary headline number.
Potentially, yes. It's a great reminder that numbers don't always tell the full story without context. Digging into those adjustments is vital. For investors, this insight is critical. Don't rely solely on headline metrics for companies in transition. Normalized figures give a much more accurate picture. Hashtag tag 9.2. How does it stack up?
Peer group comparison.
Okay, so adjusting is key. How does Cummins' valuation look compared to its peers, other big industrial companies?
Benchmarking against competitors gives more context. Generally, Cummins' valuation falls somewhere in the middle of its peer group, or perhaps at a slight discount, depending on the specific metric and peer set you use.
How does its PE compare, that 18.5x current TTM PE?
It's lower than the more diversified industrial giant Caterpillar, which often trades around 21x PE, but is currently higher than its direct truck OEM peers like PACCAR, around 16.7x, Daimler Truck, around 13.1x, and Volvo Group, around 14.x. So cheaper than CN, but maybe a bit richer than the truck makers right now. What about price to sales?
On a price-to-sales basis, Cummins, at around 1.6x TTM sales, trades at a significant discount to Caterpillar, which is over 3x sales. This largely reflects Caterpillar's higher overall profit margins and a different end-market mix with more mining exposure.
And dividends. How does the yield compare?
Cummins' dividend yield is currently around 2.0%. That compares to Caterpillar's yield of about 1.4%, and Volvo Group's, which can be quite high and variable, sometimes over 6%, depending on their payout policy.
So if you compare Cummins, it's not the cheapest stock in the group, maybe not the most expensive either, kind of in the middle, reflecting that unique mix of old and new business.
That seems like a fair assessment. It's usually priced somewhere in that range, reflecting its blend of mature, cyclical businesses and those future growth bets in Accelera. The discount to a premium industrial like Caterpillar tells you something about the market's differing expectations for their respective business models and perceived risk profiles. So, what is the market really saying with this current valuation? How is it interpreting the Cummins story?
Reading the tea leaves.
Exactly. The current valuation appears to reflect the market's attempt to balance several competing narratives. You've got the cyclical downturn in trucking, which is a negative. You've got the strong secular growth in power systems, which is a positive. And then you've got the long-term, high-risk, but potentially high-reward potential of Accelera.
Balancing those three forces.
Right. And for a company with such distinct business units, a sum of the parts, or SOTP, valuation framework can be a really useful way to think about it, even if just conceptually.
Breaking it down piece by piece.
Yeah. You try to assign different valuation multiples to each segment based on its specific growth profile, profitability, and risk.
So how might that look for Cummins?
Well, conceptually, the engine, components, and distribution segments, the mature, more cyclical parts, they might be valued using an EV/EBITDA multiple typical for established industrial manufacturers, maybe somewhere in the 8 to 10 times range.
Okay. What about power systems? The growth engine.
Power systems, with its strong secular growth from data centers and its superior profitability, would likely command a higher multiple, perhaps 12 to 15 times EBITDA, more akin to a high-quality industrial growth company.
And Accelera, the one losing money but growing fast.
Accelera is the tricky one. As a pre-profitability, high-growth technology business, it would typically be valued based on a revenue multiple, like EV sales. But that multiple would be highly speculative, heavily dependent on your assumptions about the future growth of the hydrogen and electric vehicle markets and when or if it reaches profitability.
So the SOTP approach forces you to value the certainties and the speculations separately.
Exactly. And it highlights the central question for investors. Does the current blended valuation the market assigns to the whole company fully appreciate the cash-generating power and resilience of the legacy businesses and the power systems growth? Or is it assigning an overly optimistic, or perhaps overly pessimistic, value to Accelera's long-term potential?
Is the market getting the mix right?
That's the core debate. This SOTP framework is invaluable because it forces you, the learner, to think about each segment's unique characteristics. It helps you deconstruct the total valuation and assess where the market might be mispricing the company's distinct components. The cash engines, the growth engines, and the speculative future bets.
Okay, let's try to pull this all together. We've covered a lot of ground. First off, how well is Cummins actually positioned for this massive energy transition while still needing to make money today?
I think strategically they're quite well positioned, largely thanks to that pragmatic dual path strategy. They're not betting the farm on one uncertain technology.
Using the current strengths to fund the future.
Precisely. They are leveraging the substantial and, importantly, resilient cash flows generated by their legacy ICE businesses, and especially boosted right now by that booming power system segment to fund the very capital-intensive transition towards zero emissions through Accelera.
But it's a race against time, right?
That is the key challenge. It's about timing and magnitude. Can they successfully scale Accelera to profitability before the secular decline in their core diesel markets accelerates to a point where it can no longer support the necessary level of investment? That's the critical question.
And those bridge technologies help buy them time.
Yes, the introduction of things like cleaner natural gas engines and especially the hydrogen internal combustion engines, H2 ICE, is crucial.
Yeah.
They extend the life and profitability of the ICE business while providing customers with a smoother, less disruptive path towards decarbonization. It's a pragmatic pivot. And when we look at their competitive edge in these new technologies, it's not just about having, say, the best battery or the most efficient fuel cell in the lab.
Okay.
It's about actually making it work in the real world. Exactly. Their advantage lies in their proven ability to manufacture at scale, integrate complex systems, and crucially, support these new technologies globally through that existing network.
Like the hydrogen ecosystem approach.
Right. For hydrogen, it's that comprehensive ecosystem-level strategy, production, storage, application. And the H2 ICE offering, in particular, leverages their existing manufacturing footprint and service network, which dramatically lowers adoption barriers for customers compared to pure-play startups.
And for electric.
For electric powertrains, the Meritor acquisition was truly transformative. It provided them with that complete integrated e-powertrain, including the critical e-axle technology. This elevates Cummins from just a component supplier to a full system provider, allowing them to compete head-on with the integrated offerings from the major OEMs.
So the ultimate advantage isn't just the tech itself.
It's their ability to leverage their existing global scale, their deep OEM relationships, their trusted brand, and that unparalleled distribution network to actually commercialize, deliver, and support these new solutions in ways that newer pure-play competitors simply cannot match easily. That's the power of the incumbent, if managed correctly.
Okay, what about profitability? Can Cummins keep those margins up, especially with all the spending and the market pressures?
Margin sustainability is currently a tale of two opposing forces. On one hand, you have pressure in the core engine and component segments due to the cyclical downturn in trucking and persistent input cost inflation. That squeezes margins.
The older businesses are feeling the pinch.
Yes. Although they have shown an ability to protect profitability reasonably well through proactive pricing actions and disciplined cost control. But the real counterbalance right now is the exceptional performance of the power systems segment.
The data center boom saving the day.
It's providing a powerful offset. Driven by that secular demand, Power Systems is delivering record-high profitability. Remember that nearly 23% EBITDA margin in Q2 2025. That significantly bolsters the company's overall consolidated margins.
So what are the key factors for margin sustainability going forward?
Looking ahead, it depends on a few things. A cyclical recovery in the truck market would obviously help the core segments. Continued strength in power systems is important, but most critically, over the long term, it hinges on Accelera successfully transitioning to profitability, hitting that 2027 target, and starting to contribute positively to the bottom line instead of being a drag. And this all comes back to that capital allocation challenge we discussed. It really is a high-stakes balancing act for management right now.
Try to do everything at once.
Pretty much. The optimal strategy is the delicate balance they are currently attempting to strike. They must allocate enough capital. It's essentially mandatory to maintain technological leadership in both advanced ICE platforms to meet the 2027 regs and in the zero-emission technologies to secure the future. This requires those sustained, elevated levels of R&D and CapEx.
But they also have to keep investors happy.
Simultaneously, they need to maintain their commitment to shareholder returns, particularly that steadily growing dividend and the aspirational 50% OCF return target to maintain investor confidence and support the stock price.
And the current priority seems to be?
Pay the dividend, definitely. And use remaining free cash flow after essential investments to reduce the debt taken on for the Meritor acquisition, strengthening the balance sheet.
It all depends on the core business generating enough cash.
Ultimately, yes. Their ability to fund all these competing priorities depends entirely on the cash-generating power of the core businesses, particularly power systems and distribution right now, and continued discipline in managing working capital. The immense non-discretionary capital needs of the energy transition put significant strain on doing both perfectly.
It will be a key test of management skill.
Absolutely. How successfully they manage this delicate trade-off over the coming years will be a key indicator of their long-term success.
Finally, let's address the elephant in the room for a diesel engine giant. The death of diesel. Is it happening? How fast?
Well, the decline of the traditional diesel market should be viewed as a gradual, multi-decade transition. It is definitely not an overnight collapse.
So not happening tomorrow. More like a slow fade.
A slow fade is a good way to put it, and the
Yeah.
pace will be very uneven. It will vary significantly by region and by application.
Faster in some places than others.
Yes. You'll likely see faster shifts towards electric or hydrogen in regions with very stringent regulations like California and Europe, and in certain applications like urban delivery vans and city buses where range requirements are lower and infrastructure is easier to build out.
But what about the big trucks? Long haul, heavy duty.
That's where the transition faces the most significant hurdles. The high costs of heavy-duty EVs, the lack of adequate charging or hydrogen refueling infrastructure across vast highway networks, concerns over range, payload penalties from heavy batteries. These are major challenges that will take time to overcome.
Meaning diesel isn't disappearing from highways soon.
It suggests that advanced, cleaner diesel engines, along with alternatives like natural gas and potentially H2 ICE, will remain a significant part of the powertrain mix for heavy-duty applications for at least the next decade, and likely well beyond that in many parts of the world.
What's the near-term wildcard?
The uncertainty surrounding the implementation and enforcement of those EPA 2027 rules in the U.S. is a key near-term variable that could influence fleet purchasing decisions. But the long-term trend is clear.
Slow but steady erosion of traditional diesel.
Yes. Which underscores, yet again, the absolutely critical importance of Cummins successfully executing its Destination Zero strategy and making Accelera a viable, profitable business for the long haul. That dual-path strategy is vital for navigating this multi-decade shift.
Okay, wow. We've taken a really comprehensive deep dive into Cummins Inc. today. It reveals a company in an incredibly dynamic state, doesn't it? Simultaneously, a legacy industrial giant and somehow an agile innovator.
It really is a fascinating blend. We've seen how its resilient core businesses, especially that booming power systems segment and the robust distribution network, are effectively funding its bold push into hydrogen and electric powertrains through Accelera.
And those big strategic moves, buying Mirators, spinning off Atmos, they underscore a management team actively trying to shape its future, not just react, even while navigating all those economic headwinds and regulatory complexities we talked about.
And for you, the learner, this deep dive really shows that even within long-established industries, massive fundamental change is underway. Cummins exemplifies how incumbents are attempting to make this difficult transition, leveraging their existing strengths, their scale, their network, their relationships, to build entirely new value chains for the future.
It's a fantastic case study in strategic adaptation in that high-stakes capital allocation balancing act and the intricate dance between preserving the profitable past and investing heavily in a decarbonized future.
A dance many companies are trying to learn right now.
So here's a final thought for you to mull over as you consider Cummins' journey. Think about that inherent tension. The tension between maintaining shareholder returns today, the dividends, the buybacks, and making these massive, often non-discretionary investments required for long-term survival and growth in a changing world. In a world demanding both immediate value and long-term sustainability, what signals, what clues will tell you if a company like Cummins is truly striking the right balance? Or if one priority is ultimately starting to sacrifice the other? A critical question with no easy answer, indeed. Well, we hope this deep dive has given you a richer, more nuanced understanding of Cummins Inc. and the complex forces shaping its path. Thank you so much for joining us on this exploration.
Thanks for listening.
We'll be back soon with another deep dive into the topics that matter to you.